So I do want to open this up and let everybody know, please know that I am not a CPA. CPAs are way smarter than I am. I'm not an accountant. All I'm going to tell you is I just study the tax code and try to become as familiar with it as I need to be for my clients, because I'm a financial advisor. And obviously you need to know the tax code to the best of your ability if you're advising people how to manage their money, right? But please do not make any tax moves or implement any strategy that I may say in this webinar for you without consulting your own tax person. Okie dokie. You all agree to that, please? Because again, I think this is going to be really, really beneficial and really cool. Because I'm going to go kind of line by line, not line by line, but all the important line items that you need to know on your 1040. So what's cool about this maybe is if you've already done your taxes, you got your 1040 in front of you, you can kind of go through and see what I'm about to talk about and what it looks like on your own 1040 and maybe how you can change it for next year. Because what I do find is, even though I will be the first one to tell you CPAs are probably the smartest people I know, rarely will you get a call in the month of December and have some strategies, right, of what you should and shouldn't do. Mostly you're sitting with your CPA or accountant or whatever after the fact, right? The year is already over. There ain't nothing you can do about your last year's taxes at that point. So hopefully this will help and maybe start the clock ticking, or not the clock ticking, your mind spinning on what you can and shouldn't maybe do for the rest of the year. Okay, so if that's cool with everybody, let's begin. I want to start with line 2A and 2B. Now this is going to be your taxable interest, and 2B is going to be your, did I say tax exempt? Tax exempt interest, and 2B is your taxable interest. Now, as I always say, 2A is where if you own municipal bonds, all the tax exempt interest is going to be in there. And then the taxable interest will be in 2B. So the things I always tell people to watch out for is, as many people, if you do know me, you know that one of my major niches is getting people into the 0% tax bracket when you're retired. In order to do that, obviously, we need to first make sure your Social Security remains tax-free, and that is by keeping our eye on provisional income. Provisional income is the income that the IRS tracks to find out if your Social Security benefits will be tax-free, or if half of them will be taxable, or if 85% of them will be taxable. Well, that provisional income, when they figure that out, is all added back in on your provisional income to figure out if your Social Security is going to be taxable. Okay, so it may be off to the left here on this 1040 in 2A if you have tax exempt interest, but you got to add it all back in when you figure out your provisional income, which tells you how much of your Social Security is taxed. So we want to keep our eye on that. We don't want to have too much in there if we are on the border of having our Social Security tax-free. Okay, so taxable interest. My only really thought there is, I always see people, again, if we're trying to get them in a tax-free world or, minimal taxation, we want to keep our eye on taxable interest. Now, that's all the money that's not sitting in all your retirement accounts. Okay, so a lot of times I'll have my self-employed people, if they've been self-employed, they might have a large amount sitting in retirement accounts, right? Because sometimes it's hard to get money into retirement accounts when you're self-employed. They'll have a large amount there, or people who have got an inheritance, a large amount of money maybe in a non-retirement account. Well, that's kicking off dividends, interest, capital gains, right? And I'm going to get to the other stuff later, but for right now, interest is going to show up on 2B, whatever you've got that invested in. So you've got to make sure either the investments are right, or you get it out of the those 1099 buckets, or the non-retirement money, get it into something that's tax deferred, okay, or tax free. So kind of my mantra in my business is, if you're not spending the money, don't pay taxes on it, okay? And all that money is going to be there in 2B. Diane, what counts as provisional income other than pensions? So provisional income is, you take half of your Social Security benefits, and then you add in all your 1099 stuff, which is going to be this 2B, which I've just mentioned, and then 3B, and then all your capital gains. Then you add in any money that's coming out of all those retirement accounts, the deferred accounts like IRAs, SEP, Simples, 457s, 401ks. That gets counted into provisional income. And then wages, rental income, and stuff like that. Well, that's pretty much it right there. So again, if you don't have wages and rental income, and then it's pretty simple. We just make sure we don't have too much stuff in 2B, 3B, and capital gains. And then any money coming out of IRAs can be offset by your standard deduction. And then we're pretty much there, home free. All right, so that's 2A and 2B. Let's move on. 3A and 3B. So off to the left are qualified dividends, and to the right, 3B are ordinary dividends. So qualified dividends are going to be dividends that are generated by the investments that you own, that you've held on to them for a certain period of time. Now, normally it's 61 days. You have to at least hold on to it in order for any dividend for that investment to kick off to be qualified. Okay, which means the tax rate's going to be different. I think preferred stocks, preferred shares, you have to own them, I think, for 90 days. There's a bunch of caveats here, but for the most part, you'll know which one of your dividends are qualified or not by the 1099 that you get, your 1099 DIV, or dividends and interest. Okay. Ordinary dividends are going to be dividends that are taxed at your ordinary income tax rate. So not good. You want to limit those as much as possible. I've made another video. It's on my YouTube channel if you want to check it out. But because what happened a lot last year, 2018, was people had some losses in their mutual funds. However, they've got a 1099 with ordinary dividends. So they had to pay taxes on dividends that were generated, even though their mutual fund had a loss. Okay, so that's going to really, I'll mention that again in the capital gains section of this. But if they had got any short-term gains like that, that's going to show up here. Okay, so which is why not a big fan of mutual funds. You want to maybe, if you can, go to ETFs or exchange traded funds. There's not a money manager in there buying and selling and trying to outperform the market, which most mutual funds can't even do in the first place. So ETFs kind of helps put the tax control back into your lap. Okay, so that's ordinary dividends and qualified dividends. Let me check my notes to see if I have anything to say about qualified dividends, ordinary dividends. I do not. Awesome, let's move on. All right, 4A and 4B. So that's where you're going to put your IRAs, your pensions, and annuities. Okay, so to the left, it's going to be distributions that are not taxable, and 4B will be your taxable amount. Okay, so IRA money may be able to come out not taxable. If you're keeping track of distributions, for contributions to an IRA, if you did not deduct that contribution, then that amount should come out tax-free, right? You already paid taxes on it. You didn't deduct it. So it should come out tax-free, and you just have to kind of keep track of that yourself. Make sure the IRS knows that you know that you didn't get a deduction for that money, so it should come out tax-free. Annuities, depending on what type of annuity, some of it might come out tax-free. But because for the most part, all IRA money is usually money that was put into deferred accounts your whole life, like company plans, like 401ks, 403bs, SEP, Simples, 457s, you probably deducted that. And then if you retire, that gets rolled into your own IRA and it's all taxable. So usually there's not a whole lot of IRA money that's not taxable, but it can happen. Let's see what my notes are here. If the IRS imposed required minimum distribution, not even for cash. Oh yeah, so the IRS does allow you to, if you are to the point of required minimum distributions on your IRAs. And again, when I say IRA, I'm for the most part talking about everything but Roths, all right? All retirement accounts except for Roths. They all act pretty much the same, okay? There's some differences, especially if you're still working, but it's more than what we can go into for this webinar. So when I say IRAs, I'm talking about everything. So you can, when you get to 70 and a half, you do have a required minimum distribution that you have to pull out of those deferred accounts or IRAs. You can give that RMD, the required minimum distribution, to charity. And you won't have to count it as income on your 1040. Okay, so that's one way. You've got to be at least 70 and a half and older, okay, because it has to be classified as a required minimum distribution. It's only up to $100,000. Putting that RMD or required minimum distribution into a donor advised fund, which is basically a fund that when you put money into, you get a tax deduction, and the donor advised fund then gives it to charities. Fidelity made those accounts pretty big, but that's not classified as a qualified charity. Okay, so you can't give your RMD to a donor advised fund. You just got to go directly to a charity. And the IRA custodian, so whoever has your money, like for instance, if I was managing your money, I would just make sure that the RMD check was made out directly to the charity, okay? And then you don't have to report it on your income. The other alternative is to give non-IRA money to charity. And that way you get a big deduction for doing that. And then you can convert IRA money to Roth and use that deduction to offset that conversion, because you've got to pay taxes on that money that you convert from an IRA to a Roth, right? And then now your money's in a Roth, and that way you can reduce or eliminate required minimum distributions. I always do this. I probably got into way too much detail right there. But so either give your required minimum distribution to charity, and then you don't have to report it on your 1040, or give non-IRA money to a charity, and then use the deduction for doing so to take your IRA and put it into a Roth. So that way you reduce or eliminate required minimum distributions. Okay, that's all I'm going to say on that, because I probably just confused a lot of you. So let me know if you have any questions on that. All right, so that's 4A, 4B. Let's move on to 5A and 5B. This is your Social Security benefits. Okay, and how much of those Social Security benefits are taxable, right? So on 5A, you put how much benefits you got. And then you go figure out your provisional income, which we just addressed. And based on that, either none of your Social Security benefits will be put over on 5B, or 50% of your benefits, or 85% of your benefits. Okay, those are the three options. You always get at least 15% of your Social Security benefits tax-free. Okay, so that's that. That's pretty straightforward. All right, here's line 7, your adjusted gross income. Okay, so this is after any deductions that you can take. This is an important item just because, as my note says there, your Medicare surtax is based on your adjusted gross income. Okay, and that surtax kicks in if you've got more than 200,000 if you're single, and 250 for joint filers. Okay. And Schedule A, your tax deductions like medical expenses and charitable contributions are all tied to adjusted gross income. So reducing your adjusted gross income can obviously provide lots of tax benefits. Okay. Line 8 is going to be your standard deduction. As you're probably all aware, the Trump tax plan got rid of personal exemptions and just gave everybody a standard deduction. So $12,000 for a single person, $24,000 for a retired couple. Okay. And because you're retired and you don't have much deductions in retirement, that's the figure you want to make sure you keep your eye on, to make sure your required minimum distributions don't exceed your standard deductions, whether you're single or married. And then all your money can come out of that tax-free, resulting in your Social Security to also be tax-free. Okay, so $12,000 a person. So really who got hit by that are people like me who are married and have 3 kids. So I lost the personal or the personal exemption for each of my kids. Okay. So I suffered from that little change there. Okay, so that's the standard deduction. Okay, so you take that if your itemizations don't exceed the standard deduction, right? We're going to get into those itemizations in just a minute. Okay, so here's line 9. Here's qualified business income deduction. So this is new with the Trump tax plan. Okay, so individuals with qualified business taxable income, qualified REIT dividends, stuff like that, may qualify for that 20% deduction. Me, being self-employed with my financial advising company, didn't get to take the 20% deduction because it only applies to, I'm not even sure the exact definition. All I know is I couldn't because how did he word it? The goodwill or the heart of my company is in my head. But if it was a service company, like, I sell stuff or the products are, something that's being sold that's tangible, you can take that 20% deduction. But my wife being a doctor, owning her own clinic, can't take it because all her services, what she provides is in her head, same as mine. So I didn't get to contribute to or get that 20% deduction in my industry. But if you own your own business, probably odds are you were able to, and it probably helped you out. Okay, moving on. Line 10, taxable income. So this is basically your taxable income. From after you take all your adjustments and your deductions, that's your taxable income. Okay, that's pretty straightforward. Can a single person claim head of household? Yes, Helen, if you're truly a head of household, meaning you're taking care of maybe like a sick mother or father, then yes, absolutely, you can do head of household. And again, there's another definition that I'm sorry I'm not familiar with, being able to take a head of household, but I just know the one that I deal with a lot is if you're taking care of a parent, you can claim head of household. That's a good thing because your taxes are better when you're claiming head of household. Let's see, taxable income. Okay, good. We're good there. Next one. This is really just your line 15, the taxes that you pay. I just thought I'd add this in there. That's kind of cool. To take your taxes you pay, divide by 12, and that's pretty much your monthly tax bill that you pay every month. Okay, so sometimes that's good. Sometimes people like to know that. Line 19, this is the amount you overpaid. If you did overpay, it's clearly right there. So you want to make sure that you deal with that for next year so you don't overpay. The differences between there could be, if you were supposed to pay your quarterlies, your taxes, okay? If you overpaid in all those estimated quarterlies, that's going to be right there. You want to make sure you check that. You don't want to overpay to the government if you can help it, right? Okay, that's that. Moving on to line 23, estimated tax penalty. There's a number here. You've got to make sure that you eliminate this for the following year, okay? You don't want to obviously have a tax penalty. And that could be from things such as underpaying your estimated quarterlies. If you're in that position where you're paying estimated quarterlies, okay? If you underpay, you might have a tax penalty. There's a certain ratio there, a certain algorithm that, again, people smarter than I know, if you work with a CPA or accountant or whatever, they'll know that. Line 13, capital gains. So this is, if you're selling a security, you're going to get these capital gains. Now, in most cases, you should have a negative amount there, right? A negative $3,000. That's the maximum that a taxpayer is allowed to take losses on. If you sell something that you have a profit in, you can offset that with some losses plus an additional $3,000. Okay, every year you can write $3,000. There's no deadline for that. You can keep writing off $3,000 every year if you have a major loss. Okay. Let's see, what's my notes here? If it's in a 12% tax bracket, the lower capital gain rate is 0. Yeah. Oh, this is big too. Capital gains. Something to know that if your income is in those two bottom brackets, the 0 or the 10% or the 12%, just remember that there are no capital gains. Okay, the capital gains rate is 0 if you're in that 10 or 12% tax bracket. Okay, so married filing jointly, you're up to about $78,950, and married or single, you're up to $39,475. If your income is below that, at or below, you don't even have any capital gains rate. So you can kind of keep that in mind if you're trying to do some tax moves there, and maybe that there's going to be a year or so where you can show a low income. Well, that's the year you want to sell everything, right? Because your capital gains rate will be 0. Most people don't know that. They assume that they always have to pay some sort of capital gains if you sell something, but it's not true. If your income bracket is in the 10 or 12% bracket, you do not own any long-term capital gains, okay? Really important stuff there that a lot of people aren't aware of. Line 28 on your Schedule 1, this is for self-employed people. Okay, so if you've got a SEP, which is a simplified employee pension plan, or simple, already qualified plan, there's where you want to make sure you put in your contributions. Okay, a pass-through or from a pass-through activity reported on Schedule E. That's from like rental income. If you have rental properties, okay, that's a pass-through activity that's on Schedule E. Okay, so you want to make sure if you are self-employed, you fund the heck out of whatever you can, a SEP or simple. SEP is basically for if you don't have any employees, or maybe you just have like one or two and you don't mind contributing, because you do have to also match employees if you're contributing to a SEP. So it's really good if you don't have any employees. If you start to have multiple employees, a simple is good. I believe that's still up to 100 employees. There you'd still, yes, you do have to match. But there's like, you can skip 2 out of 5 rolling years and blah, blah, blah. But basically, that's where you want to put that in. And a lot of times I don't even know how much I can put into my own retirement account until I talk to my CPA when I'm doing my taxes, because it's based on an equation. You know, your adjusted self-employment income less this, less that, and then you add this. I don't know that. I warned you. I opened up this webinar, which I'm not a CPA or an accountant. All right, I just try to familiarize myself with as much as the stuff that I need to know for my clients. All right, so if you got a business, put your money in there. Okay, cool. Schedule 1, still line 32. This is your IRA deduction. Okay, so if you can deduct an IRA contribution, okay, if you can't, then maybe you should just put it into a Roth, because you can't deduct Roth contributions. That's all after tax, but all the money you make is tax-free. Where if you put it into an IRA, whether you deduct that contribution or not, all the gains are taxable. So if you can't deduct the IRA contribution, maybe you should just put it into a Roth anyways. Okay, if you can, you got to have earned income still, right? Same thing with a traditional IRA, but you do have income limits for a Roth contribution. Okay, I think this year it's sorry, I don't have this in front of me. I think it's like it started to phase out around 193,000 if you're married, and about half that if you're single. Okay, but if you do contribute to a traditional IRA, and you don't deduct it, I alluded to this in the beginning of the webinar. This is that form that you need to fill out, 8606, because that tracks your basis, meaning it tracks that contribution was not deducted. So that should come out tax-free when you take out money in the future. Okay, so good stuff to know there. Absolutely. I'm not going to get into the IRA deductions only because I don't know it off the top of my head, whether you can deduct a traditional IRA contribution or not, because it's complicated. It depends if you're single and married. The income's different. It's different if you're single and have access to a company plan. It's different if you both have access to a company plan. So it's just follow the formula or ask your tax guy or gal if you can deduct the IRA contribution, right? But just so everybody knows, a rule of thumb, I hate IRAs. Those are probably the worst place to put your money. Fund a company plan if you get a deduction. Other than that, put it into a Roth. That's what I always say. Usually IRAs are the worst place to put your money. Okay, no questions there. Moving on. Schedule 2. This is just your alternative minimum tax. Anytime you do taxes, you got to run it through basically run it through 2 systems. We have a dual system in our federal tax system. And they want to make sure that you're not so good at avoiding taxes that you're going to have a minimum tax. All right, so you're going to have to pay the higher of the 2. Okay, so if you've got an issue there, then obviously you need to make sure you fix that for next year. But with this new Trump tax plan, less and less people are going to have to pay that. Line 62, that's your taxes from those 2 forms there, if you guys can read that. So here's where the Medicare surtaxes on earned income kicks in. So again, that's for if you're single making 200,000 or married 250. So not most people, let's put it that way. Itemized deductions. So if your itemized deductions exceed your standard deduction, then you will take itemized deductions. Okay, so here, for instance, line 4 is your medical expenses. You want to make sure that because in 2019 it's increased from 10%, you want to bundle as much medical expenses as you can in 1 year if you think that will hurdle that 10%. Okay. So, if you're going to itemize a bunch of things, then you're going to want to again, see if you can bundle that up in 1 year. Okay. eligible expenses that you can bundle, just to name a few. I'm sure there's more out there, but like out-of-pocket fees to doctors, dentists, chiropractors, psychiatrists, psychologists, feet doctors, and other medical people. That's not covered by your Medicare or the health insurance. Okay, so health insurance premiums, as long as they weren't paid with pre-tax dollars. And then premiums for long-term care insurance and payments to nursing homes and other long-term care facilities all count as medical expenses. Dave says, is it a good idea to roll IRA money to a Roth and pay the tax so the growth will be tax-free? The short answer is yes, Dave. If any article you read in the media, that's usually that's the only feature that they focus on a Roth, and they say, all right, so if you're young, it's a good idea to convert to a Roth, so you've got a long time span to make up for the deduction that you would have got. If you're old, why bother putting it into a Roth? There's no time, blah, blah, blah. There's so many other benefits to a Roth that it's almost always a good idea to convert some money to a Roth, right? You should absolutely still have some money in like a traditional IRA, because again, you can take all that money out of a traditional IRA, and as long as it's less than your standard deduction, it can come out tax-free. So you don't want to convert everything to a Roth if you can help it. But converting to a Roth, all your gains are tax-free, yes. You never have to take it out. There are no required minimum distributions for a Roth, so that can help keep your Social Security tax-free. If your kids inherit it, they get an awesome tax-free gift. Okay, your traditional IRA, your kids can never convert to a Roth. So lots of awesome things about a Roth. So if it makes sense for you, absolutely do it. Anne says, my mother was put in a nursing home in Puerto Rico, and I'm responsible for the additional cost. Can I deduct an expensive? So which ones? Oh boy, that's a really good question. That's international stuff, so I just don't know. That might be if you're a head of household. You can't be head of household. She doesn't live with you. So I'm going to guess no, but you might want to look into that yourself. And they're not even your expenses, so I'm going to highly doubt that those are deductible. But yeah, I'm sorry. You know what? I'm not going to even pontificate on that one. I apologize. Again, like I'm not a CPA, but so that sounds like a more question for that person. Awesome, good questions though. All right, so bundle those itemized deductions if you can. Here on line 5E, those are just taxes you paid. So the deduction on taxes paid is limited to 10 grand for single and married filing jointly. That's taxes you paid on that's what they call SALT taxes, right? State, what's that stand for? State and local taxes. Yeah, SALT. So that's line 5. It's now limited to 10 grand. That's all you can write off, right? Okay, cool. Gotcha, Ann. Yeah, still not sure. Sorry. Okay, here's gifts to charity on Schedule A. So consider donating appreciated investments instead of cash, which is very tax inefficient. Also consider lumping charitable deduction to the one tax year again to hurdle that standard deduction of $12,000 single or $24,000. Okay, consider using a donor advised fund, which I alluded to a little bit earlier. Those are the funds that you put money in and you get a nice fat deduction, and then they'll give it to charity for you. You can even pick the charity that you want if you want. Okay, so that goes there. Did I hit on everything I wanted to hit on? I think that's next. No, you know what? I didn't hit on the mortgage interest thing again. Oh yeah, that's on here though on Schedule A. So depending on you can itemize interest that's paid on the principal of mortgages. If your first and second resident mortgages, they can't be more than $750,000, right? With the new Trump tax plan. Interest on home equity loans is no longer deductible, except if you use it to buy a home or you use it to improve your home. Okay, so if you use a home equity loan to pay off bills, it's no longer tax deductible. Okay, so if you have trouble hurdling that standard deduction, consider prepaying like your January 2020 mortgage interest. If you're getting really close, pay that in December of 2019. So you can maybe, again, hurdle those taxes. And if you're married filing separately, let's go back. to the SALT, yeah, then it's only $5,000. Okay, $10,000 for single and married filing jointly, but if you're married filing separately, it's only $5,000. Okay. Okay, awesome. Capital gains. This is Schedule D. So these are capital gains distribution. Mutual fund capital gains distributions are reported here. This is kind of what I referred to earlier, where you might have like losses in your capital or in your mutual funds for 2018. And then you look at line 13 here and you've got capital gains distributions, which really makes people mad, which is really why I don't like mutual funds. And that's because they're buying and selling all year long, right? They're trying to beat the benchmark, which with after all these taxes and fees, they can't. So this is what really irritates people the most is they have losses in their mutual funds and then they open up their 1099s and they have to pay capital gains distributions and they lost money. So that's why you want to try to be in exchange traded funds if you can. Those just make sense. Okay, cool. Line 16 on that is total short-term and long-term gain losses or gains and losses. Again, if this line's greater than a negative 3,000, then you have a capital loss carry forward, and you can reduce the number by a negative 3,000 again to determine the loss carry forward for the next year. And like I said earlier, capital gains losses carry forwards indefinitely. So if you've got like a $60,000 loss that you're writing off, you can continue to write off $3,000 every year. In fact, you can say that you've got $60,000 of a loss that you're carrying forward, and you carry forwarded $3,000 year one. So you've got a $57,000 loss. You can use that full $57,000 if you want, if you've got a $57,000 or thereabouts gain in another fund. So you could sell that 1 year and then offset it by that full $57,000. You don't have to limit it to $3,000 every year. Okay, and that way that gain that you had, basically what you do, you sold it, and then the capital gains taxes you offset by that loss that came from some other investment, and then you can buy that investment right back again, and now you have no taxable gains on that security, right? So if it grows again by another whatever, you're just paying taxes on the new gain, not from the very beginning, because you sold it, bought it back, offset the losses, and make sure you're careful of the wash rule. Okay, we can get into that later. Good stuff. Good stuff. Hey, that's it. Awesome. How long did it take? 36 minutes. Not too bad. Very purposely went high level here because I know what I know, but I don't want to pretend like I'm some tax expert by any means. Okay, but if you do want to take the next step and learn more about how I take what I know with the taxes and put it towards your portfolio, and how I can make people pay zero taxes in retirement, then you're going to want to visit my website, taxhackerclass.com. Again, taxhackerclass.com. That's right there in front of you. I'm hearing a beeping noise. Sorry. Go to taxhackerclass.com. You can watch a webinar that's pre-recorded. I air it every hour on the hour. You can watch that of a previous webinar that I did. And I really go deep down into how to set up your account so you pay 0% taxes. And at the end, there's something that you can take advantage of if you want my personal assistance with anything you got going. Awesome. I hope you enjoyed it. Diane's got one more question. If your provisional income exceeds the standard deduction, should one try to convert all IRAs to Roth or a LIRP? Okay, let me think about that one for a minute. If your provisional income exceeds the standard deduction, right? So we're confusing a couple different topics here. If your other income, meaning your income maybe at this point, if it's just coming out of, let's keep it simple. So money coming out of your IRAs, if that exceeds the standard deduction, then that money does need to be added to your provisional income. And depending on what your Social Security is, you may be able to do that while keeping your Social Security still tax-free. Okay, so remember, you got to take your Social Security, divide it by half, and then you've got those tiers in provisional income. Too much for this webinar, but so not necessarily. Your income can exceed the standard deduction, and everything still could be tax-free. But I guess to answer your question, Diane, if let's say if your income does exceed the standard deduction, and that does cause your provisional income to make your Social Security taxable, then yes, you should try to convert all your IRAs to a Roth or a LERP. Okay. Hope that makes sense. Confusing, I know. Diane, are you a tax hacking masterclass client? Because it seems like you know the lingo. So if you are a tax hacking masterclass client, Diane, I can personally look at your situation and show that to you and customize a plan for you. If I haven't already, I don't know. I've done it so many times. All right, awesome. If there's no other commercial or questions, that's all we got for today, guys. Thanks for joining me. Hope you enjoyed it. I'll make sure everybody gets a replay of this so they can watch it over and over, and make sure you call me with questions or email me or whatever you want. Have an awesome day, everybody. Later.